As you can see, I'm not James Bogart. My name is Pete Knorr. I'm one of the financial advisors with Bogart Wealth, and I will be covering the retirement income planning seminar today, one of my favorite seminars. And it looks like most of the people have filed in already, so I'll go ahead and get started. And I'll start with just a few words about who are we, who is Bogart Wealth, for those who this might be their first time. So we are a registered investment advisor, which means we don't work for a bank. We're independent of any bank. Our clients have their money at Charles Schwab, and they give us a limited power of attorney to be able to buy and sell things inside their account, basically manage their money for them. Well, we haven't updated this. It's 1.4 billion now under advisement, and I'm not sure about the household count, but I can say we still are in the position where 90% of our clients are major oil company retirees, and that really means ExxonMobil retirees. Although there are people from other companies as well, but that's the bulk of our business. By law, we're required to be a fiduciary, which means always putting the client interest first, always acting in good faith, making full disclosure if there are any conflicts of interest at all. This is most of our team, so we actually can't quite keep this slide up to date. This shows 18, we're up to 20. This shows 5 advisors. We now have a 6th advisor in the Woodlands office, by the way, and the rest of the folks here are just to support you, in addition to the direct interaction with the advisors. We also have the ability to seamlessly get your taxes done. So this is our tax team. They're not on this slide. They're not actually Bogart Wealth employees. It's a exclusive relationship that we have with Troy Callahan, CPA. We have 3 different locations. We started in McLean, Virginia, just a couple freeway exits north of Gallows Road, if that means anything to you. When we realized that Gallows Road was not going to be there long term, Bogart started hunting in Houston. I was one of the first clients they found, so I'm a former ExxonMobil employee myself. And then, of course, it became obvious we needed to have an office in the Woodlands. So the biggest office is still McLean. The second biggest office is in the Woodlands, Hughes Landing Boulevard. And then I'm out here in West Houston because we still have a sizable client base in West Houston. Our mission is to help clients achieve financial peace of mind by maximizing and preserving intergenerational wealth. And a part of that is that we will give advice to your children and to your parents if necessary, as we know that these are 2 parts of your life that can greatly impact your financial security. Today's presentation is one of a series. The retirement planning timeline covers every topic about retirement, but about 1 inch deep. And all the rest of these dive down into individual details. This is one of my favorites, so I love doing the retirement income planning, and hopefully I will go through it quickly enough that I don't fall in love with any particular slide. And the unhidden agenda is to get you to sign up with us for a one-on-one financial strategy session. No cost, no obligation, because while we're covering a lot of topics here, we have to cover them in a general way. And sometimes until you try to apply it to your individual situation, it's a little difficult to see how to apply some of what's in some of these presentations. Okay, so the agenda today, I've already done the introductions. I'm going to breeze through the overview to get down into the real nuts and bolts of the retirement income planning process. I have the chat open. I have the Q&A open. I will at least acknowledge your questions as they come up. Sometimes they'll be answered later in the presentation, and I'll tell you that. So why do income planning? I want to go right to the bottom line. Creating income from your portfolio is fundamentally different from building wealth. So you've been working on building wealth for 20, 30, sometimes 40 years. This is going to be different. Okay, so you need a plan to help you see the risks, plan for the risks, make informed decisions when retirement time comes, to make those decisions, to understand how to have a predictable income and a sustainable and appropriate withdrawal strategy so your money lasts a lifetime. And once you have a plan, then you can tell whether or not you're on track with the plan. Everybody's retirement is different. So you really have to think about your family, your health, your home. Some people are going to retire to a new location. Some people have been planning this for a long time. They have a retirement home. It's been their vacation home, and now they're going to move there. But you really need to create the plan for what your retirement is beyond not going to work every day. Lifestyle, some people are going to continue to work. I retired from ExxonMobil in 2013. I'm still working. I will keep working as long as my health and my wife's health allows that to happen. That's not most people's idea of retirement. Okay. Legacy. This is very, very important for a lot of people, is what happens after they die. And so you need to think about that. And then what is it that's going to keep you from wanting to die? What's going to keep you wanting to live during your retirement? So everybody's going to be unique in that way. This is a survey that was done by the Financial Planning Association, the FPA, about 10 years ago. And they asked people what were their most important goals in retirement. They could select from a list, and they could pick more than one. So clearly you can see this adds up to more than 100%. But the number one was basically having a reliable income in retirement. And number two being one that keeps up with inflation. And then not having to worry about whether they have enough money or not. Helping their children financially. And we finally get to something that's not a financial goal. So when people think of retirement, even though I'm telling you it's about more than money, and you need to think about what you're going to do in your retirement to keep your mind active, to keep your body active, still what people worry about the most is the financial aspect. So forgive me, but for the rest of this, I'm just going to talk about the financial aspects. So I mentioned a couple of slides ago that there are risks in retirement. These are the major risks. One is longevity. So I mentioned people having plans to leave a legacy. So I'm often having to remind clients, I'm worried about what happens if you live. Okay, so people are living longer. Well, I know that's not quite true with 2020. Okay, people are going to live longer again. So for a couple who are both age 65, it's about a 50-50 chance. So one of them is going to make it to 90. There's a 20% chance that one of them, at least one, will make it to 95, and a 4% chance that one's going to make it to 100. Now that's based on the 2019 mortality tables. And as I sort of alluded to, maybe 2020 is going to skew that a bit. So we'll see. Inflation is certainly going to be a factor. We haven't had 3% inflation in a long time. But okay, it may be coming again. And with 3% inflation, just pick a number, 50,000. it's going to be cut more than half in 25 years if you have just 3% inflation, just a little bit over the Fed's target of 2%. Market performance, of course, very important, volatility, and the sequence of returns. So lower returns or negative returns early in retirement might not be recoverable. It's not the same thing at all as when you're saving money for retirement. And then healthcare costs keep going up faster than inflation. So a recent study, the Financial Advisor Retirement Income White Paper by Fidelity, estimated that a couple age 65 will spend almost $250,000 in retirement to cover their health care, and that's not including long-term care like nursing home or assisted living. That is just your medical expenses, direct medical expenses. So basically, you need a plan that takes these risks into account and how you're going to manage things that you can't actually control. So what is retirement income planning? Well, we can use all kinds of historical averages, but you're not average. I can tell you that. And so we basically need to customize to what your goals are, what your assets are, and then we can talk about average lifespans, average inflation, average returns, future tax rates. So this is the process. The first thing we will do with you is a retirement analysis, and it's the first thing I'll cover today. And then we'll talk about investment strategy and withdrawal strategy. I personally like to do these two things together when I'm talking with clients, but we can't do it together in a webinar. So we're going to do investment strategy 2 and withdrawal strategy 3, and then we'll talk about implementation, monitoring, and reviewing. Okay, so number one is basically we need to understand what's going to make your retirement unique. You know, you're going to move to the West Coast. You've already built a house. You're building a house. You got a lot, but you haven't built the house yet. You're going to move to Lake Livingston. You're going to move to the hill country, whatever it is. How much income will you need over time? So a lot of people start with, well, what am I spending now? But things are going to change over time. People often spend more in their first years of retirement than they ever did while working. But they're going to tend to slow down. And at some point, they're going to slow down a lot. Okay. So the more realistic, the better you understand your expenses, the better plan you're going to have. And people are often surprised. They ask me, what is the one thing that I can really do to be ready for retirement? And they expect it to be something about, well, save more. No, it's understand your expenses better. Okay, so all kinds of lifestyle choices, understanding what's essential to you versus what might be discretionary, making sure there's enough set aside for emergencies, and how you handle cost of living adjustments. This is data from the Bureau of Labor Statistics. It's the average American. I already told you, you're not average, okay? So this is split by age categories. So this is not following the same people over time. It's just taking a snapshot in time and saying, how much are people in this age group spending versus this age group, and what are they spending it on, okay? But what we find with our clients, do a first approximation, although the numbers are all wrong, the trend is right. And that is that when people go from, let's call this late work environment to early retire environment, that their spending goes down in almost every category, except we see it go up in entertainment, okay? We really see this one go up by 30% instead of down by 30%. But okay, this is what the federal government statistics are telling us. Healthcare for sure is going to go up. For sure is going to go up. When you go from an ExxonMobil employee to an ExxonMobil retiree, your costs go up. And that's not because the company is subsidizing any less. I swear to you, that when I retired, my costs only went up by 10%, okay? But if I look at what ExxonMobil retirees, married couple would be paying today, it's about the same as when I retired. As a retiree, my costs have gone up every year. So basically, the culture of health has held down the cost for ExxonMobil employees, but has had no impact on the costs for retirees. And you will see that in one big hurdle when you retire, okay? But the 65 is really talking about Medicare. And what you're going to find is very little change when you go from the ExxonMobil retiree plan to Medicare, because you already got your surprise when you went into the ExxonMobil retiree as opposed to the employee group. Okay, let's not fall in love with this slide. Let's move on to what happens at 75. It goes down more. So if you look at the net down 21%, or if you annualize this, it's 2.3% reduction per year for 10 years. You're eating inflation as a retiree, and not because you can't afford to keep your spending up with inflation, but because you just don't really want to spend as much as you used to. Okay, so that's what generally happens is you go years, slow go years, and no go years. Okay. So I like people to think in terms of where is my income going to come from in retirement, and think of it as a three-legged stool, that a portion is going to come from Social Security, a portion is going to come from the pension, and then whatever those two don't make up is going to be the gap. And if you think of it in terms of income replacement, Social Security is going to replace somewhere between 90% and virtually nothing of your gross income by design. So the design of Social Security is, if you're a minimum wage kind of employee, it's going to replace 90% of your gross income. Okay, well, you're not a minimum wage employee. For the median income in the United States, it's designed to replace 42%. So it's 90% of this first tranche, 32% of this next tranche. At the median income of the United States, which 2021, the number is 72,000, it's 42% of your gross income will be replaced. And then for the next tranche between median income and the maximum covered earnings, so the maximum that you're paying Social Security tax on, it's only replacing 15%. And so right at that maximum covered earnings, 143,000 in 2021, it's 27%. And from there on, it covers nothing. And so if you go out far enough, you get to that, theoretically, it's less than 1%. It is the point where James would always say, and I'd love to meet you, but okay. So the people we're dealing with are somewhere in this range. The paraprofessionals, perhaps down here, the professionals and executives, perhaps up here. Okay. The pension, it's easier to think of it as income replacement ratio if you think annuity, but the lump sum is just the present value of the annuity. So the annuity is designed to replace between 12% and 65% of your gross income. And the 12% is somebody who's 55 and 15 and for whom Social Security is not negligible. The 65 is for somebody who's, well, they're probably 65 and a board member, okay? So the formula is 1.6% times your years of service times your average pay, your pensionable pay, which is the highest 36 consecutive months out of the last 10 years, which is always the last 3 years, unless you went on limited work, disability, something like that, then you're not penalized for that because they'll look back at the higher income that you had a few years back. And then they subtract the Social Security offset. More about that in another slide. So for the typical career employee, what do I mean by that? Somebody who started right out of college at age 22, they work till 60, it's going to replace about 50%. But here is what the curve looks like. So if that person retired at 55, well, they're taking the discount off of their pension of 5% a year, and they have less years than that person at 60. Okay. And so they're gaining 8% a year in this range, 5% a year because of the early taking the pension earlier than age 60. They're losing 5% a year, and 3% a year increase for years of service. So 1 year out of 33 is 3%. Okay. 1 year out of 40 is no longer 3%. It's 2.5%, and I'm rounding that up to 3. But that's kind of what the curve looks like for should I work longer. So it says age of benefit commencement. Well, it's retire and commence the benefit immediately. For somebody who's, I'm going to make it to 15 years and I'm going to retire as soon as I can after 15 years, well, they're only getting that 5% a year on waiting to take the pension till age 60 because they're not getting any more years of service. So this can't possibly be an individual. It's a concept of 55 and 15. What age did I hit the 15 years at? Okay, so that gives you your 12%. This gives you your 50% that I was talking about on this slide. So if we say this is 15%, let's just pick 20 here. That's 70% income replacement. Can you live on 70% of your gross income? Well, that depends. You're paying Social Security tax, you're paying Medicare tax. Those go away when you don't have payroll anymore. Okay, so you don't need 100% necessarily to maintain your standard of living. Now, if you're going to add some more travel, add some more entertainment, well, okay, you might need that money back. And if you're saving 20% for retirement, you might be able to live on just 70% between these two. Of course, one problem is you can't start Social Security at age 62. I mean, at retirement, unless you retire at 62 or later. And this slide is set up for full retirement age, which for most of you, that means age 67. Okay. And so if you started at 62 instead of 67, that's 5 years early. It's a 30% haircut off of what's in this chart. So you're not getting the 20% anymore. Maybe it's down to 15% of income replacement. Okay, so you probably need some savings in addition to Social Security and pension. And for a whole lot of people, these are the two biggest components. And then, Social Security might be as low as 10% for some of you. It might be as high as 30% for some of you. Okay. I said I'd come back and mention how the Social Security offset works. The idea of the Social Security offset is you've been paying into Social Security all the time you've been working, and your employer has paid exactly the same amount, okay? And they want their half back. So the company in their infinite wisdom said you should have 1.6% times your years of service, times your pension will pay. But this government thing, that's totally different, and we were forced to pay into it, so we want our half back. But what if you didn't work there all of your career? Well, then they don't deserve all of it back. So the formula is 1.5% times years of service up to a maximum of 33 1/3, because these two factors multiplied together cannot be more than 50% of the Social Security you're expected to get at age 62. So if you take it as soon as possible. Now, then that begs the question, well, what happens if I retire after age 62? Well, okay, it's the as soon as possible then. So it's not really age 62, it's really as soon as you can start Social Security, what will your Social Security be? And then they get up to half of it, less if you worked less than 33 1/3 years. Okay. So that's everything I have to say about step one, how we go about talking to you about your retirement income overview. Okay, so how much money do you need? Over what period of time do you need it? And what are the sources of that income? So then the next question is, okay, so if I take the lump sum, if I have money in the savings plan, if I have money and my spouse has a teacher's retirement program, 403B, whatever, how would I invest that to create income in my retirement? So that we're on to investment strategy. And there are 5 basic elements of it. Don't think that you're going to pick one of the above, because a comprehensive strategy often has several of these strategy elements in it. And we're listing this going from the lowest risk to, I'm not calling any of these high risk, because all of these are very basic strategies for retirement. They're all time tested as good strategies for retirement. But the annuity is the only one you can use the word guaranteed with. Everything else, there's no guarantee. Okay, so these are the 5: annuities, bond ladders, income-oriented investments like dividend-paying stock or preferred stock or master limited partnership, fixed asset allocation. Some people use the name modern portfolio theory. Let me come back to that. And dynamic asset allocation. So let me just give you the highlights of each of these. I guess before that I was supposed to say, but whatever you do, make sure you have a plan, because emotions can destroy your plan. And the 2 biggest emotions are fear and greed. When you're greedy, you can be a little fearful. But I'll tell you, when fear takes over, greed just leaves the building. Okay, so we definitely want to have a plan that will prevent you from making wrong decisions based on emotions. Okay, so annuities. First, let me say that if you really are thinking about an annuity, you really should consider the one that the company offers, because it's triple guaranteed. Whereas something you buy in the market is guaranteed by the insurance company you buy it from. Now, there's another little secret that I'm not supposed to tell you. If I was trying to sell you an annuity today, it would be illegal for me to tell you that your state also has a fund that backs up annuities. So if you buy an annuity from an insurance company and it goes belly up, then the state of Texas, of course, if you move, it'll be another state, but the state you live in will also have a guarantee fund, okay? May not cover 100 cents on the dollar. But the annuity from the company is triple guaranteed. So it's guaranteed by ExxonMobil Corporation as long as they're around. If they dry up and blow away like a leaf in the fall, the trust, the pension plan itself, is a separate trust, okay? So it would not be affected by whatever it is, catastrophic event that happened to the corporation. And then if that blows away for whatever reason, it's backed by the PBGC, by the government. So folks who were union workers for GM, and GM went bankrupt, and the pension plan for the union workers went bankrupt, They're getting their money from the PBGC. I have a client who has a father that's in that situation, and the father said to my client, you should take the annuity. So, okay. But there are three basic types of annuities. There's a fixed annuity, and that's what the company's offering you. And you can compare that to a bank CD. It's going to have a relatively low, but very stable return. There's indexed annuities and there's variable annuities. The way to think about this is indexed is pretty new. So fixed annuities have been around for centuries. And in the 70s, when we had high inflation, nobody wanted a fixed annuity anymore. So the insurance industry came up with this idea of a variable annuity, which is just like a mutual fund wrapped inside an insurance product. And it's going to go up with the market. So if the stock market does well when bank CDs are returning nothing, then a variable annuity would have been a better choice. And it's held in a totally separate account. So it feels very, very much like having a brokerage account at an insurance company. Okay. The problem is it's laden with fees and they eat your lunch and you never get the actual market return. And when the market's down, you still have the fees on top of that. So people pretty much figured out this was not a great deal. And the sales of variable annuities dropped, and the insurance companies said, well, we need to sell more annuities. So they came up with this idea of an indexed annuity, where they operated a lot like a fixed annuity, except they also buy options in futures markets. And so then they can give you a percentage of market increase. Like the market goes up 12%, you will get 3/4 of that, okay, with a cap of 7.5%. Well, 3/4 of that was 8, so you get 7.5, okay? But they also usually have a floor. And a lot of times that floor is 0 so that you cannot lose money. And this makes it very attractive to a certain portion of the market, and the indexed annuities are the ones that are doing the best these days. What the company's offering you is a fixed annuity. I can't see any reason why you would buy a fixed annuity outside and that you wouldn't just take the annuity offered by the company or a partial annuity. But if you said, well, the thing that's holding me back is this fear of it being fixed and future inflation, okay, maybe an indexed annuity. I'm not a big fan of them, but I'm here to tell you how they work. Okay, the next sort of rung up the ladder of risk would be what's called a bond ladder. Okay, you can invest in bond funds, but the value of bond fund is going to move inversely with interest rates. And so you are encouraged to buy individual bonds because if you hold them to maturity, then you'll get your money back as long as the company didn't go bankrupt. But okay, that's a whole other story. So what you would do to even out the interest rate over a cycle is you would build a ladder. And this is an oversimplified example, so I can fit it on the slide, which is a 3-year bond ladder. So to set it up, you buy a 1-year bond, a 2-year bond, a 3-year bond. But then as each of these matures, you buy a new 3-year bond. Okay? So what would you really do? You'd probably buy a 5-year or a 7-year bond ladder. And why? Because if you look at the bond yield curve, it goes from short-term rates are really low, long-term rates are higher, but they don't go to the moon. They kind of curve over and flatten out. And so you want to be at the knee of that curve where it stops getting more fun for more years, where it takes a lot more years to get a little more fun. So probably a 5 to 7 year, which would then have 5 or 6 or 7 rungs in it to have your bond ladder. And the idea here is that you're living off of the interest that's coming off of each of these bonds. And if you really need more money, every year, you've got a leg of the bond ladder is going to mature. And so you're going to have extra money every year. Of course, that means you're whittling away at your seed corn. The real problem with bond ladders is the interest rates have been so low for so long that nobody can live off of the interest in bond ladders anymore. I don't have a single client who has a bond ladder for income. I have some who have bond ladders, but it's a special purpose. It's a special reason. Forget about them. It's a one-off deal. For retirement income planning, I don't know anybody relying on bond ladders at this time. So instead, what they're relying on is like dividend income. So if you can get a bond ladder in the 2.8 to 4.7% range, these would be kind of high risk bonds today. Then you would do better with preferred stocks and dividend paying stocks. Now you might say, well, this 3 to 6 doesn't look a heck of a lot better than this 3 to 5. But the difference is that dividends tend to go up every year. So for example, here, this is an example that maybe nobody would live with today, but okay. Back in the day, a whole lot of people put all of the money in their savings plan into ExxonMobil stock, and they thought in terms of, when I retire, I'll take the annuity, and yes, it's a fixed annuity, but I'll have the dividends from the ExxonMobil stock. The combination of those will completely replace my income. I have clients like this. And the dividends go up every year. Well, okay, they didn't go up in 2020, and okay, people were worried in 2020 they're actually going to cut the dividend. And okay, they still might, who knows, but still kind of stick with that old mindset for a minute. And I've got two different portfolios here. One of them is ExxonMobil. The other one is something we manage that we call our prime income portfolio. If you put $100,000 into each back in 2000 and you do not reinvest the dividends, you have to live off the dividends, okay? So you would have gotten $2,000 in dividends, 2% yield back then from ExxonMobil, but the dividend did go up every single year and never went down, versus we had, a little over 4% dividend yield on the prime income. So you got twice as much money that year, and it's gone up not every year because it's not one stock, and it's not always the same 24 stocks, okay? So you can see, for example, between 2008 and 2009, your income actually went down, but it popped back up in 2010, 2011, okay? And then last year we had another reduction in the income on that portfolio, but overall you're seeing a pretty good compounded growth in the dividends. Okay, now the underlying stock value, well, it changed over time, and both of these kind of went down in the 2008 timeframe, and both of them came back up. Now since 2014-ish, since I retired, what is it about me leaving the company? But anyway, so from this time frame, it's not been a great deal to own ExxonMobil stock. This portfolio continued increase in value, did take a big hit. All dividend paying stocks took a big hit last year. Why? Because people were worried, are they still going to be able to pay dividends? If they owned real estate, would they still be able to collect rents? Now that wasn't true for digital real estate, but okay. So overall, people were worried about the sustainability of these dividends. But that's kind of the idea. If you want an income-oriented portfolio, you're probably going to go with dividend-paying stocks. If you look back at these over 200 years, the dividends have gone up faster than inflation, not every single year. But somebody who retired in the 70s used a dividend income strategy, get to the 80s and look back, they're doing pretty well. They get to the 90s and look back, they're doing great. Now, the problem with that is, of course, people want to spend more money when they're young in retirement. Yeah, they're worried about what happens when they're 90, but they're a lot more worried about what happens when they're still in their 60s. Okay, so moving on. The next strategy up, we said, was a fixed asset allocation. So what I'm showing in this chart is if you had a mixture of a pure bond fund and a pure stock fund. And by the way, what I'm using here is for the stock fund, the S&P 500. So if you think in terms of the savings plan, this is equity units. And the bond fund is the most ubiquitous bond fund. It is the Barclay Capital Aggregate Bond Fund, which is exactly what the bond units are in the savings plan. And then I'm mixing them in different proportions to see how you would have done and what would have been your worst year in this time period. You can pick any time period you want, by the way. I just picked the most years I could conveniently get. So what was your worst year and what was your average year? And this is in real, that is excluding inflation returns during this period of time. So you see the bond fund, you might have lost on the order of 13, almost 14% in your worst year. And if you added some stock to it, your chances of losing money went down while your probability of gain went up. And it's like, well, how can that be? Well, this is not a law of finance, but when is it that a bond fund is at most risk? Well, bond funds go down, as I told you, when interest rates go up. They move inversely to interest rates. When are interest rates generally going up? When the stock market's doing really well and people are worried about inflation. Well, really the economy doing really well, which generally means the stock market's doing really well. So in the years that you would have lost money in a bond fund are exactly the years that you really ought to have money in stocks, okay? And different people have done this analysis in different ways and come up with slightly different conclusions. I have the minimum risk at 40%. I've seen other papers where they say the minimum risk is 35%. But okay, in that range, 35 to 40% is your minimum risk. 60% is an interesting point because it's basically the same risk as 100% bonds, which most people would think, well, that's as conservative as you can get, 100% bonds, but almost double the return. Now, from 60% on up, yes, you're getting more return, but you're getting substantially more risk as you increase. So for most retirees, if they're going with a fixed asset allocation, it's going to be somewhere between 40% if they're very conservative and 60% if they're kind of average. And some people, you know, they just like a little more risk. Okay. But I would say 60% is where most of our clients have their money, and 40% is the next most popular spot. Now, I mentioned the words before, modern portfolio theory, and a lot of people see the shape of this curve and it reminds them of modern portfolio theory. Modern portfolio theory, first of all, modern means the 1950s. I always imagine orange naugahyde when I think of modern portfolio theory. It may be avocado kitchen, but it was developed in the 1950s by these very intelligent college professors for the purpose of illustrating to undergraduate students the benefits of a diversified portfolio in reducing the risk of your investments, okay? So just like a college professor, to take something that's like intuitively obvious, but we have to prove it mathematically, okay? And they got Nobel Prizes for this. Smart guys, good work. They never intended it to be used to manage an investment portfolio, okay? Because to use modern portfolio theory, you need to have the cross-correlation coefficients among all the asset classes you're going to consider for your model next year, okay? So anyone who offers to manage a portfolio for you using modern portfolio theory, and they're going to charge you money for this, I would run. Because one of two things: either they don't know what modern portfolio theory really is and how the theory works, and that they cannot possibly know the correlation coefficients next year, or they do know that. And I think the second one worries me more than the first, you know? But okay, if you like the idea of fixed asset allocation, we will help you set it up for free. Nothing. Okay, so why do anything beyond fixed asset allocation? Well, because the world changes. So here's just an example. At the start of the 20th century, railroad stocks were 63% of the entire stock market in the US. And 100 years later, practically nothing. Russia and India and Austria-Hungary, they were 25% of the global equity market. And then, of course, you know, you had the Soviet era, you had nationalization, Austria-Hungary didn't exist anymore. Okay, so the scale of these kinds of changes says that having a buy and hold or just set and forget kind of approach, okay, so that's why dynamic asset allocation. One way to think about dynamic asset allocation is, I told you in the fixed asset allocation, no, I forgot to tell you, in the fixed asset allocation, things aren't always going to move in lockstep. And so there'll be years when stocks go up and bonds go down, and whatever your allocation was before, it's different now. Okay, so you're gonna have to sell stocks on the way up and buy bonds at that same time to get things back into the balance that you wanted them to be in. Okay, one way to think about dynamic asset allocation is, well, don't do that. Wait until you can see that the rise in the stock market is probably over and now rebalance. Otherwise, you know, you're kind of cutting the legs off of your fastest runner, okay? Fixed asset allocation works perfectly as long as the market always does what it's supposed to do. But sometimes it doesn't, and sometimes it doesn't for multiple years. So basically, I've gone back as far as I could. 1881, I got this out of a book by Benjamin Graham. Who's Benjamin Graham? He was the college professor and the first employer for Warren Buffett. So who's Warren Buffett? Well, he's that guy that everybody thinks is brilliant in stock market investing. So okay, so it's a pretty good source. And what it's showing is we have these multi-year declines in the stock market. And this is the kind of thing that can really hurt a retirement. And this is part of why I think you need to have a more dynamic asset allocation instead of a fixed asset allocation, so that in these years of decline, you're not constantly buying more stock as it's going down to keep you at the 60-40. And not only that, but you're not likely to be able to stick with the religion if every year that you put money into the stock market is going down, down, down. Now, most of us don't remember any of those periods, but 2000 to 2002 was one. And before that, we hadn't had one since the 70s, okay? So most of us grew up in kind of a charmed existence where we learned that fixed asset allocation, dollar cost averaging, buy on dips, that's how you make money in the stock market. And it's like, well, if you have enough time, you'll make money in the stock market that way. But you'll worry about this in retirement. So, okay, so these are the sort of reasons why we like dynamic asset allocation. We're not trying to time the market. We're just watching the trends, okay? And people say, well, so what kind of factors are you taking into account? The prices reflect every factor there is, whether it's geopolitical, economic, new sectors, new opportunities, interest rate changes, they're all in there. And they all make different asset classes have rise up or go down in the scale. Let me illustrate that with this picture. I could probably get one that has a 2020 column by now. But anyway, you probably can't read these, but each color is an asset class. Okay, like this one is US fixed income. So that's US bonds. And you can see in 2001, it was at the top, and then it was number 2, okay? And then it fell all the way down here to number 3. The second from the bottom. But, it's like you weren't losing money. So sometimes the worst on the list is not losing money, and sometimes the best on the list is not making much, like here, 5 1/4. It went up 8.4% when the stock market was crashing. Why would that happen? So bonds go up when the stock market is crashing for 2 reasons. One is people are selling stocks. They put their money someplace, bonds. The second is the Federal Reserve is cutting interest rates to stimulate growth in the economy. And I told you the bond fund's going to move inverse to interest rates. So they cut the interest rates, it goes up. Over this 3-year period of time, the stock market, US, S&P 500, down 50%. The bond market, as represented by this aggregate bond fund, up 30%, okay? So this is why most people like a mix of stocks and bonds in retirement. But okay, what this is basically showing you is that the winners change over time. For sure, emerging market was the place to be, and international right behind it in these years running up to 2008. Since then, emerging markets have come up a few times, but Europe, okay. So those are the 5 basic investment strategy elements. And a lot of people end up with more than one of those elements in their overall investment portfolio. So now we talk about the withdrawal strategy. And there are 3 basic approaches, although you can mix and match with these pretty well. There's an income-only approach. So that says you're just going to live off of interest and dividends. And that probably means you're going to focus on an investment strategy that has a lot of interest and dividends, okay? The idea behind income only is you cannot run out of money if you never sell anything, okay? You cannot run out of money if you never sell anything. You own things that are creating dividends and interest. The problem is it may not be enough. And that's the problem for most people, because they want to spend more in the early years and they're counting on spending less later on, and they don't have Social Security in the early years. So it's all coming out of their savings. Okay. And so income only works for a minority of our clients. So then you've got, let's jump down here to systemic withdrawals. The easy way to think about this, and I'm going to oversimplify it a bit, is put half of your money into stocks and half your money into bonds and go with a fixed asset allocation. Every month you need money. You see which one of these 2 piles is bigger, the stocks or the bonds. That's what you take your money out of. And over time, if that's not enough to keep them approximately the same, you will occasionally sell more of the one that's bigger and buy more of the one that's smaller. That's real simple. What's best about it, it guarantees you'll never sell when the market's at its peak, because, I mean, you'll never buy when the market's at its peak because you're selling as it goes up. Okay, and you'll never sell when the market's at its bottom because you're always buying on the way down. So that's the fixed asset allocation strategy. It works just as well. This withdrawal approach works just as well without a fixed asset allocation strategy, but the easiest way to think about this and conceptualize this is that. So the advantage is, if you can follow the religion, it guarantees you will never make those worst mistakes that people make, buying at the top and selling at the bottom. What it doesn't guarantee is that you won't run out of money. Okay, it gives you great flexibility that you can withdraw more now, less later, but it doesn't give you any guarantee about not running out of money. So you have to have a way to know, am I running out of money or not? And I'll get to that in just a minute. And then there's the bucket approach. So this is for people who have trouble sleeping at night when there's market volatility, which happens to a whole lot of these people. So they want something that's very steady to fund the next year or 2 or 3, and then something that has a little volatility, but not much, please, for kind of the next tranche of years, maybe out to year 10 or so. And then the rest of it, fine. Put it in a growth portfolio. You know, I can ignore it because I know I got plenty of money to live on for the next 10 years. So that's kind of popularized by Susie Orman, but it was around before she was born. Bucket approach to retirement income planning. And then in managing distributions becomes a question of, what do I take the money out of? So kind of the rule of thumb is you take it out of the non-qualified accounts, so ordinary accounts, after-tax accounts first. That lowers your taxes early in retirement. Then you take from the qualified accounts, well, you have to at age 72 anyway because of required distributions covered down here. And you leave the Roths to the end because it's the best thing for somebody to inherit, okay? And then they're always there in case something unexpected happens and you can dip into it and it won't push you into a higher tax bracket. So at age 72, you have to start these required distributions. Whoever is the custodian of your IRA, Schwab, Voya, Fidelity, whoever is the custodian, they're deputized by the government to rat you out if you fail to withdraw the percentage required. And the tax penalty for that failure is 50 cents on every dollar you failed to pull out. And you still have to pull it out and pay your ordinary taxes on it. So if your ordinary taxes, 22 or 28%, and you're paying 50 on top of that, yeah, that's pretty bad. Okay. So this is what required distributions look like. Forget this new distribution. It's proposed, but who cares? It doesn't really matter unless you live past 105. So at 72, they're starting out at about 4%, but they're going up. In your 90s, you're getting to 10%. So the issue is that for a whole lot of people, if they've saved enough money and they saved it in retirement accounts, then it pushes them to be making higher distributions than they need to live on. So it's pushing them into a higher tax bracket, okay? And so it can end up with a case like this, where somebody has like a 10% tax bracket early in retirement, okay? And then they've run out of their after-tax money and they're bumping up to, this higher 33% bracket. And then as the required distributions percentages are going up, then they're hitting this 35% tax bracket out in time. And, that could be great, but if they could possibly minimize this by paying a little bit more tax in here, and the idea is to do Roth conversions. So this is their base case. They had a little bit of Roth, tiny little bit, to start with. But now here, basically, we had them doing 100 to 200,000 a year for 4 years. So it's greatly growing their after-tax assets. And if you look at how much money they have at the end, 13 versus 12.9. Okay, so it didn't really increase their net worth at the end of the game by much, but it greatly reduced the required distributions and more over time. And so basically they paid higher taxes we call this the bump case. We bumped them up against a tax bracket. That's how we determine how much Roth conversion to do. And you see that basically they paid a lot less tax out here. If you die young, you didn't get any of that benefit. So I had a question way back, and I missed it. I apologize for missing it. It was asking about dynamic allocation. Aren't you just chasing past performance if you're using the trends to tell you what to invest in? And what I would say is there's definitely a potential to do that. There's definitely the potential to sold after the decline and then bought after the recovery. So it's a lose-lose transaction. That's definitely potential for doing that. And if every stock market move in the future is more like 2020 and less like 2000, 2001, 2002, then you'd never want to do dynamic allocation. Never, 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 never. Okay. So that's the real question is, are we going to ever have a return to a world that looks like this? Or is every stock market crash and recovery in the future going to be like 2020? I think 2020 was kind of unique. But okay, so Roth conversion is all part of that withdrawal strategy. Withdrawing from different types of income and different time periods is part of determining your withdrawal strategy overall, and being cognizant of these different tax rates. Okay. So when you're in the 10 to 12% ordinary income rate, you could be enjoying 0% capital gains. So, knowing where you're getting your income from in each different time period and whether you're going to take advantage of these low tax years to have zero or to do Roth conversions, you can't do both. Okay. So then review and monitor. So clearly, one of the benefits of having a plan is that you can see how you're doing relative to the plan. Are the assets moving the way they were supposed to? Is the income coming in the way it was predicted to? Is your spending what was anticipated? Okay. I definitely want to cover this chart. So I told you that if you're doing a fixed asset allocation or even a dynamic, you really need to keep an eye on things to know, am I going to run out of money or not? And, this is a simplification like anything is. But what this is basically telling you is how long a portfolio will last in years based on an initial, with a little star next to it, withdrawal rate. So the withdrawal rate's going to go up every year based on inflation. And I would say in year 43 of this curve, your withdrawal rate was 100%. So all it really means is if you have $1 million in year one and you want to follow the 4% line, then 40,000 is your limit. Okay. And if you're withdrawing 40,000 a year and then having it step up every year based on inflation, and if you're getting a 3% real return, then it will last 43 years. So if you're 60 years old, you can live to 100. Okay. If you're pulling out 50,000, it's only going to last 29 years, which, well, that's fine if you're already 70. Okay. But a lot of people are starting out with 5 and 6% withdrawal rates and then counting on that withdrawal rate goes down when their Social Security kicks in. That's okay. As long as they're doing that with their eyes open, and when the Social Security kicks in, they cut the withdrawal rate. Otherwise, they're going to run out with the 6% in 22 years. And there's not too many people, 82 years old, want to go back to work. Okay, so this is a really good chart. Again, it's oversimplified, but I really like it. I use it all the time. And okay, so basically your retirement paycheck, start with initial withdrawal rates that are reasonable. Have a foundation for your essential expenses, have a withdrawal strategy, particularly for the discretionary portion of it. Have a diversified portfolio with some downside protection. Okay. And it will last for a lifetime. So basically, when we review with clients, we're looking at how's the return been. Okay. Is the withdrawal strategy working for you? Are you staying up at night worrying about volatility? If so, how are we going to change the portfolio to help you with that? So there's a lot of factors. You really need to have a plan. We'd really like to help you with that plan. And what we would say is when you're looking for an advisor, you want one who is a fiduciary. You want one who has very transparent fee structure. We think you should look for certified financial planners and somebody who knows your retirement plan, who understands the IRS rules, who has experience over multiple business cycles, who manages their own portfolios. A whole lot of advisors, they're more like salesmen. They don't manage their own portfolios. They farm it out. They're willing to discuss more than one strategy and that they will track your performance versus your plan. It's not once and done and goes in the shelf or never pulled out again. And you can understand them when they're talking. So I'll leave this slide up for a few minutes. If you want to contact any one of us by phone or by email, Mindy's the one who controls everybody's calendar. So she might be your best bet. And if there's no more questions, then I'll kind of draw it to a conclusion. Thank you for attending.